Yuval Rooz is the co-founder and CEO of Digital Asset, a New York-based technology company which is behind Canton Network. Digital Asset Holdings is building next-generation cryptographically secure settlement and ledger services. The company is providing safe and efficient settlement of conventional and digital assets, as well as providing a digital ledger to create, issue, track, and transfer mainstream financial assets. Prior to starting Digital Assets, Yuval managed an electronic algorithmic trading desk at DRW. Before joining the DRW Group, the venture capital arm of the Chicago-based trading firm run by Don Wilson, co-founder of Digital Assets. So Yuval, great to have you here to Markets on Chain for the Global Blockchain Business Council.
It's great to be here. Thank you.
So let's start with tokenization. That's really been a hot topic lately. I just heard the SEC chair, Paul Atkins, talking about his support for it and what he thought it could do. How do you see tokenization working and helping people?
Sure. So first of all, I think it's important to understand why is everybody excited about this. And, we've seen in crypto markets that everything is moving 24/7. The reality, though, is that in crypto markets, everything is fully pledged, meaning there's no leverage, there's no collateral. You just trade with what you have. And we know that traditional markets are not like that. And if we want traditional markets to move to 24/7 or be more efficient, we need to be able to move collateral more efficiently. So one of the most exciting opportunities around tokenization is just the ability to move, collateral real time. So stable coins was a great step forward. You could move variation margin this way. But now, we've seen yesterday DTCC announce that they're going to put US Treasuries on Canton, probably the most important collateral globally. And so that's just one aspect of tokenization. But, it's also this idea that today we really can't use our assets for anything other than trading them. Like you cannot take your equity holdings and use it to guarantee a loan, for example, pretty seamlessly. So a lot of the excitement around tokenization is the ability to have more utility out of your assets beyond just being able to move them 24/7.
And as I understand it, it kind of democratizes finance too. Like people would be able to say invest in a little piece of a famous work of art. Maybe you don't have the whatever millions to buy it. That you could tokenize things like that.
Yeah, you can, technically speaking, you can tokenize everything. I sometimes say to people, just because you tokenize something doesn't make it liquid. There is an element of tokenization that makes the servicing or managing of an asset significantly cheaper. And because you make it cheaper, then it democratized the access because you could actually trade smaller and smaller increments of whatever asset it is.
Yeah.
At the end of the day, I think that people will still have these kind of assets that will have much more gravitational force around them. Tesla stock, SpaceX stocks. And yeah, maybe there will be new asset classes that just because it's easier and cheaper to trade them,
Yeah.
will create some gravitational force.
Yes, we'll see. We'll see how it all shakes out. So now, why use distributed ledger technology to map business logic, reducing complexity, improving efficiency in areas like loans and derivatives and foreign exchange? So how much is that being used now? And what are the benefits and challenges to that?
Yeah. So the reason to use blockchain or distributed ledger technology is that it really forces everyone that interacts with the ledger to agree on what is the data model of an asset and what are the functionality that exists. And as a result of that, once you do a transaction on a distributed ledger, everybody agrees on the source of truth in real time. Where in traditional markets today, that takes, in best case scenario, hours, and in certain, broadly syndicated loans, it could take over a month to actually settle a transaction. So the real interesting feature of blockchain and distributed ledger technology is that now you could actually mobilize assets 24/7 in real time, and you can now add programmability to actually introduce those assets into different types of services. As I mentioned, pledge your Apple stock into secured loan. So you could go now and get a loan from someone by pledging your Apple security into it.
Now, part of the Canton Network is privacy. So how do you ensure that financial data remains confidential?
Yeah, so I don't know if we'll have time to go into all the technical details, but
Yeah.
maybe if we just take a step back, I think that what the crypto industry have shown very well over the last 10 years is that there's a lot of excitement and also a lot of opportunity by mobilizing assets in real time. Stablecoins is just a great example of what success can look like. The reality is that if we want large institutional adoption to come, large scale institutions would not be comfortable with everybody seeing what are their positions. My former employer, Citadel, would not be okay
sure.
if everybody would see all of the trades they do on a daily basis,
Right.
all of their collateral movements. A treasurer of a publicly traded company would not be okay if the whole world would see what are the payments that are taking place by this company, right? So for us, when we started building Canton, privacy was a must-have. And now the crypto industry have woken up over the last 6 months, and now suddenly privacy is one of the biggest things that everybody's working, and we've been very fortunate to think about it 10 years ago.
Okay. So you're kind of ahead of the game when it comes to that. Now, what novel operational risks in digital asset infrastructure or market structure does the capital markets risk mitigation framework aims to address that existing regulatory or industry standards do not?
Yeah, so I think if I take a step back, like for example, a term we use in finance a lot is DVP, delivery versus payment.
Okay.
And it sounds like as if those two things happen instantaneously. They actually don't. Those things happen on different rails. And sometimes the delivery will happen, but the payment did not happen, or the payment happened and the delivery. And that's what we call settlement risk or settlement fails. And it happens daily, right? So the opportunity with blockchain technology is really to reduce all of this settlement risk. And we're seeing that already in many different applications that are being built both on Canton, but in many cases also on other networks.
Mhm. Now, how does RMF translate risk categories like operational, legal, government risk into practical decision-making tools for regulated capital market participants like banks, asset managers, market infrastructure providers?
Yeah, so I think that one of the things that we're trying to do is really take existing frameworks. The Basel Committee has rules around like how do you need to capitalize. And what we're trying to do is we're trying to show that with this new technology, you're not doing anything new. You're actually just accepting same frameworks. But the reality is because this is new technology, people are going to, for the next few years, look at the characteristics. Do you have privacy? What are the downtime, uptime of these networks? What happens if something bad were to happen? What are the emergency procedures? And I think very similar to the internet for the next, 5 to 10 years, we're going to see some additional frameworks being created to measure the risk associated with using this new technology. But after time, we're going to fall back to really just saying we have the same frameworks of what type of collateral, how much we need to capitalize our balance sheet, but the technology will just be assumed to be working.
And then why is it important for Canton Foundation and Digital Asset to collaborate with the Global Blockchain Business Council, GBBC, and engage with other industry reps in this initiative? And how is it critical to the credibility and adoption of the capital markets focused RMF, particularly across jurisdictions with differing regulatory expectations?
Yeah, sure. So first of all, big shout out for GBBC. I'm a board member there, and Sandra built an incredible team. But I mean, the thesis again of this industry is that we're trying to bring a lot of organizations, industries, governments to kind of work together on a common protocol.
Yeah.
And although the technology is capable of doing that, if I define, for example, a bond in the US one way and a bond gets defined, let's say in Europe, a different way, well, it doesn't matter that the technology can allow to interact seamlessly. From the technology perspective, these are two very different things. So one of the things that GBBC does very well is to try to create global standards of how do we define financial instruments? How do we define all kinds of interactions? And then also the risk framework of how should we evaluate the risks associated with this technology? So really what GBBC is trying to do is to harmonize as much as possible. The reality is we're not going to have full harmonization across legal entities, legal jurisdictions and countries, but try to bring education and knowledge across these different sectors. And for us as Digital Asset and Canton Network, again, we want to be part of a global world. That's why we love to collaborate with.
Sure, and you're kind of on the ground floor here to really, write the definitions and the standards of this industry that's growing. So yeah, looking ahead. So how do you see the RMF evolving as tokenization on public blockchains move from pilot projects to a more of the systematically relevant scale?
Yeah, so I think it's similar to what I said before, which is in the next 5 to 10 years, we're going to see more and more people use this technology. We're going to have to think about what are the risks associated with this technology. We're going to have to write procedures, no different than how we think about cyber risk today with the internet. So this technology will have elements that would be unique to this technology, and those risk frameworks, will improve over time and will, be inserted into financial institution operational playbooks, right? And over time, this technology again will become just like the internet, which we just accept it. And these risk frameworks, again, over time will change less and less and less, and will just become part of our business as usual procedures.
So just kind of a final thought. I mean, how do you see blockchain technology working its way through society, like the end user? What will it mean for them?
I think that today we don't think about the fact that we use HTTPS or TCP/IP or whatnot. We don't think that we use now tap with a phone, even though it's not that old. Right? We just accept these technologies. So today there's quite a lot of fascination. What is the consensus? What is, how do you do certain things from a technical perspective? Even you asked in this interview, like how, so there's fascination because it's new. It's allowing to do things that we haven't been able to do. I think what we will see is that stable coins and different on-chain payments will become a thing of regular use. That my hope is that if you and I do an interview in, a few years, we're going to talk about, what is quote unquote the Google or the Meta or the OpenAI on blockchain. We're not just going to talk about blockchain. We're talking about the use cases and the businesses that are driving, but we're no longer going to talk about blockchain anymore. We're just going to accept that that's just an infrastructure that mobilizes assets for us.
Yeah. Okay. Well, it's fascinating to learn about this over the past few years. So, Yuval, thank you so much for coming and sharing your insights.
Thank you. And nobody talks about it. Yes, it happened. But the reality is, when you think about wanting to bring real world assets on chain, one of the challenges is that if we really want to have institutional activity, we really have to bring the actual asset on chain, not an IOU, not a wrapper, the actual asset.
Welcome to High Stakes, the podcast where Web3 meets the real world. I'm your host, Alex Nwaka, co-founder and CEO at Validation Cloud, and former principal at Touchdown Ventures, where I led enterprise SaaS investments. Each week, we sit down with the founders, investors, and institutional leaders pushing the boundaries of blockchain, AI, and infrastructure. If you're navigating regulation, building at scale, or trying to separate noise from signal in emerging tech, you're in the right place. Let's get into it. Welcome back to another episode of High Stakes. I'm your host, Alex Nwaka, and today I have Yuval Rooz, who is the CEO of Digital Asset. Welcome, Yuval.
Hey, thank you for having me, Alex.
Absolutely. So you've been around the digital asset space for over a decade, but have a very long career in traditional finance before that. So maybe I will turn it over to you to talk to the audience and give them a bit on your background and where you come at the digital asset industry from.
Sure. So I studied electrical engineering and then was recommended at a career fair to apply to Citadel. I was very fortunate to start my career there. They had a program that took people from a technical background and taught them finance. So I started effectively as a quant at Citadel. And from there, I moved to DRW Trading, where I did ETF market making, and was also very lucky to get the opportunity to start DRW Ventures. That got started the same year that Cumberland got started, which is around 2012. DRW Ventures is really just looking at investments on everything that is related to DRW's core business. And DRW's core business is for the most part trading. And then when Cumberland got created, it was also trading crypto. So I started looking into this space. And then at the end of 2014, both myself and the co-founder of Cumberland, his name is Eric, decided to leave DRW and to start digital assets.
Awesome. And maybe give a sense to the audience of digital assets, sort of the core mission, what you all do, and really the constituencies you feel you touch as like your primary audience.
There is no primary audience, I would say, for us, as much as when we build Canton or start thinking about Canton, our view is that you need to always build for, the most restrictive, the most risk averse, the most stringent client, which are usually institutional clients, mainly because if you can do it for them, you can do it for everyone else. And I think that if you start the other way around and you try to then retrofit your offerings to large institutional players, you're going to run into challenges, and we can talk about them later. So for the most part, most of the clients that we have worked with early days are large-scale regulated institutions. I would say that today, people that are using Canton are also retail and other types of offerings. But again, I believe that most of the value can be proved or will be proved by large institutional players doing significant amount of on-chain finance.
And just so the audience has a sense of the connective tissue or how these different components interrelate, there's digital asset, the corporate level, there's DAML, and then there's Canton Network. Can you maybe just talk about how those interrelate, just so the audience has a sense of these different names and terms we're going to be using throughout?
Sure. Digital asset is what would be the closest to labs of Canton. Canton is the ledger and DAML is the smart contract language. On purpose, we didn't want to call ourselves Canton Labs, mainly because our view is that these networks need to be decentralized, need to be bigger than maybe the original thinkers. And we just want to be market participant and ecosystem participant and not be viewed and be able to prove it as kind of like the puppet master behind a chain. And I think that that's an important component. And it doesn't just come in the form of the name. We can talk about the tokenomics, how we launched the token, the governance. Across all of those aspects, we wanted to make sure that Canton can become a bigger thing than any one participant.
And when you think about the current state or landscape of institutional adoption in the space, how would you frame that for the audience? Again, you've been at this for, let's call it a decade or more, right? So I'm curious how you would describe the current state of institutional adoption and how that has evolved in the most recent 12 months.
It's a great question, but I think that maybe some context need to be explained before. So I think that the question is, what in our view is required to have institutional adoption? And I would say that currently institutional adoption in crypto is for the most part trading crypto, right? Like there is no real scale around on-chain finance. I think that our view, and now you'll see a lot of people talking about that, there's a few elements, but maybe two in particular. I think a lot of times people said that the reason there was no participation on chain is because of scalability. I actually think that scalability is not the issue. As we've seen with every technology, if the technology proves the business use case, scale will come. Similar with cell phones. Eventually, technology will pick up the performance that is needed to supply the demand. A thing that I think most other crypto offerings haven't been thinking about early on is, for example, if you're a large scale institution, you don't want your peers, your competitors to know what it is that your business does. That's your IP, that's your competitive edge. If you're a publicly traded company, there's a lot of analysts or hedge fund analysts that are really trying to kind of back calculate into what is your activity. Now imagine you just put all of that on chain for everyone to see. One of the things that we've always thought about is privacy. Now you'll see a lot of people talk about privacy today. We don't believe that they're necessarily using the same type of privacy we talk about. Again, for us, privacy is the ability for people that have no stake in a transaction to know that that transaction took place, but for you still to be able to comply with regulation, be able to share information with those that need to audit you. That to us is privacy. So that was one component. And then the other one is, and this is, I don't know if this is going to be controversial, but, a lot of times people say, one of the advantages of crypto is that it's immutable. And I say, yeah, crypto is immutable until a hack happens. And then we kind of reverse the hack and, nobody talks about it. Yes, it happened. But the reality is when you think about wanting to bring real world assets on chain, one of the challenges is that if we really want to have institutional activity, we really have to bring the actual asset on chain, not an IOU, not a wrapper, the actual asset. Because if I am Capital Group or Wellington or Citadel or any one of those institutional players, if they're holding equities, they want to know that they are holding the equity, not a representation, not a derivative of the equity. Because at the end of the day, when things go bad, they want to know that they have the actual asset. And the reality is, in order to do that, one of the things that make DeFi so powerful is that I can deliver assets into a DeFi protocol in real time for a few cents. And what you call in traditional finance, I perfected the security. That is the only books and record of an asset is the chain. DeFi is really cool, right? I can do all of these things in real time for almost no money. The problem is that you want to have the same experience on real world assets, and therefore the chain need to become the de facto books and records of an asset. So when we went to build Canton, we didn't ask how do we create yet another faster, cheaper consensus, but we actually said, no, what are the first principles that this chain will be able to satisfy? Meaning an issuer would be able to trust that this is the books and records and no third party can meddle with it, whether it's via 51% chance attack and things like that. Like they know that they have full sovereignty and control over their books and records. And therefore they're comfortable saying the chain is the books and records of my asset. You have privacy and all of those things. So I think that it was more of coming at it from really thinking from like first principles of what will be needed to truly conduct on-chain finance. And then the next phase was, okay, now let's actually go and test that with clients. So I think that, there's a few examples, but like we have clients like Broadridge that are doing now $400 billion of repo every day. Now, a lot of times people in crypto don't believe me because, 400 billion, it's almost kind of like the entire crypto volume when you think about crypto asset. And I try to explain to them 400 billion is not enough. It's not even 10% of the repo market in the US alone on a daily basis. But that being said, it is close to 10% and it's real. We work with iCapital, which is the largest feeder fund provider that are moving feeder funds natively on chain. We have life insurance, annuity companies that are issuing these products natively on chain, mortgages, on and on. And then the one that is very exciting is we did a project with the DTCC where now you can hold a US Treasury at the DTCC natively through Canton. So, that's just maybe a taste of some of the institutional use cases that we've been working on.
What's been the biggest challenge when you speak to institutions who may be either, let's call it blockchain skeptical or just blockchain maybe like undereducated? What do you spend most of your time unpacking for them? Is it the privacy aspect? Is it the security aspect? Which aspects do you find that you spend the most time educating folks on?
I think that one of the biggest challenges in crypto is that a lot of already existing capital market products just get reinvented. The marketing is great. I'm truly very excited. But the reality is that, again, if you think about it from the lens of an institutional player, they have fiduciary responsibility to their investors. This is not just retail playing or trading or investing with their own money. You have fiduciary duties. And as a result, you expect them to be more cautious than participating with their own personal money. And when you go and you create all of these new terms, I'll give you an example: looping, leverage, staking, securities lending. yield farming, structured products in all kinds of like covered calls. And these are great names that have created a lot of traction. But then you try to go and explain the difference to a large institutional player. So there's a lot of education, first of all. Second of all, I think that because marketing needs to be concise, people will just say privacy, or people will just say tokenization. Well, clearly not all tokenization projects are created equal. There are some people that do tokenization in a very risky way, and there are those that do tokenization in a really safe way, but they both call it tokenization. And I think that this massive influx of these terms and people that are using the same terms to do things different, requires a lot of education. So I would say that a lot of times, most of my time is being spent on trying to explain the nuances between all the different approaches and the different words.
How do you measure success within an institutional blockchain deployment? Is it just how much capital is being moved on a daily basis? Are there other KPIs that you look at that signal to you success or growth that is healthy?
I'll give you an example. Something that a lot of times people will look at is how many assets have been issued on chain. And although I think it's an important metric, I don't think it's the most important metric. At the end of the day, the whole value of blockchain is to create better utility. It's to reduce the OpEx and the cost of issuing and managing assets, all the way through to then moving them and using them in terms of different financial functions. And therefore, I mean, you could see that there's just so many native issuances that have taken place, but then since that happened, there's zero utility associated with that asset. And therefore, I think that the best metric on success is going to come in the form of how much dollar utility people are willing to spend on your chain. That, to me, is the most important metric. Not how many users, not how many wallets, not how many assets have been issued, how much dollar utility have been burned on your chain.
Yeah, you mentioned a very impressive list of folks, and not an exhaustive one at that you all currently collaborate with. In some ways, these are, you're building somewhat of a consortium, as I think about it, of, and constellation of customers. They're very diverse in terms of what they do. How do you keep, such a diverse group sort of aligned on where digital asset is going and sort of push everybody forward in what I would call maybe a consistent and direct way, if that makes sense? And then how do you communicate a direction of travel to take the space? Because I very much view what you all are doing as you're really trying to lead the institutional vector down the path of the highest likelihood of adoption of this technology. And you're talking to folks that might be on the trading side, folks that are on the asset management side. There are folks that are in the financial services, like core infrastructure space, like DTCC, that all have different bones to pick in sort of the traditional financial markets. And so I'm just curious how you chart the path forward so that you can drive the highest dollar value outcome in terms of utility for the space in the shortest amount of time.
I think that our success to date, and hopefully going forward, beyond just the proof of the network and what is happening, is that, again, you come to an institutional player and you're using the language that they use. You understand what are the things that they're worried about. You can explain why you design certain things the way that you've done. And it comes from a place that understands their business, their concerns, and the things that they have to manage. I'm not saying that it wins a contract for you. I don't think that it necessarily gets you through the finish line, but it allows you to have a real constructive conversation that is anchored in reality. You can also say, we're just going to do everything from the ground up because we know better than everyone. In many cases, it works. By the way, I'm not necessarily challenging. It's just not our approach of how to do it. And I think that has worked for us, at least successfully, understanding the subject matter expertise there, but also being able to kind of understand where are the challenges of the clients.
And do you have any sort of well-worn thoughts today about potential future interoperability between Canton and other institutional networks? Or Have you sort of thought about this as something for a future conversation, or is that something you're thinking about actively today?
Generally speaking, what I'll say is that interoperability, first of all, is yet another one of those words that take a lot of shapes. What do we mean by interoperability? Is interoperability saying that I want to take an asset that was created on Canton and I send it to Ethereum, it's no longer on Canton and now suddenly it's on Ethereum? Is it when I do interoperability, is I can lock it on Canton and now I can create it on Ethereum? Like, what does that mean? Is it a message-based interoperability? Is it at the protocol level interoperability? Again, so many different flavors to just a single word, one of those loaded words that get used in this space. What I will say is that I cannot talk on behalf of Canton because everything that is happening in Canton now is decided by the community. But my personal view in a digital asset is we would love to collaborate with anyone, including our competitors, as long as we see that there's business value to our customers. So let me give you an example. Let's say that Canton was driving all of the largest clearinghouses in the world. Let's just imagine a world that this is what we've ended up being able to do. And now these clearinghouses said, you know what? We're willing to accept Ethereum as eligible collateral for our networks. We go, great. Let's interoperate with Ethereum that we can mobilize those type of examples, because now there's clearly value for our customers to do that. And, I think that that's just the approach that we've taken. So honestly, one of the things that I'm excited about the most, for example, there's already now interoperability between Canton and Bitcoin, for example, where you could actually have bridged Bitcoin on Canton, and now you could trade Bitcoin on Canton with privacy, which is a really cool thing. Like today, every time you trade Bitcoin, everybody gets to see it. You could pledge Bitcoin as collateral for options exchanges with privacy without anyone seeing. If crypto exchanges are willing to accept wrap Bitcoin on Canton, you could even send your Bitcoins to exchanges. Our view is, always think about interoperability, collaboration, or partnerships, as long as it makes commercial sense to your audience or customers.
And I'm curious, you've had exposure to a lot of different asset classes throughout your career. When you think about the asset classes that maybe make the most sense to move on to blockchains sooner, how do you think about the factors that would weigh in on that sort of framework?
There isn't just a simple answer. The answer is, what are you trying to do? So I'll give you an example. Like a lot of times people will say, well, US equities are a very efficient asset class. It's very cheap to trade, blah, blah. I'd say that's true, but for example, trading US equities 24/7 is not simple, or you can't pledge equities as collateral against loans or things like that. So there's many aspects of US equities today that as a result of the rails that they exist, even though specific rail is efficient, it prevents you from all kinds of possibilities that today are not available for you. So for example, most of us that hold equities really see none of the benefit of lending those equities to others. We don't. But if you could actually hold a US equity natively in your wallet, and then there's going to be things like Aave, for example, for equities, boom, now suddenly I can actually give my equity and I will get some return based on what market conditions say I should get for lending my equity. And I think that that is one aspect on an asset class that has a significant amount of efficiency already, when you think about it in the context of what is available for that asset today, which is for the most part trading, but there's a lot of elements that are currently not available for it from a connectivity perspective. I think that that adds tremendous value, and I think that's why you're seeing a lot of people excited about tokenized equities. Then there's a whole segment of asset classes that have massive inefficiency and are huge in size. So that's like the whole private markets. Massive amounts of reconciliation, a lot of inefficiency, a lot of friction. That being said, there's still really large asset classes. So there you have an opportunity not only to bring connectivity into these products, but also like to make them significantly more affordable for people to hold and have many dimensions. And I will tell you, we work in both of these spectrums. I will say the other element in many cases is who do you need in order to make tokenization a reality? And that should be another element of like, is it going to require regulatory changes? Like, are these institutions, like, for example, a lot of times people talk about real estate. I think that it would be amazing if title houses existed natively on chain, because then you would really be able to do cool things with real estate.
Maybe a very, very challenging and maybe impossible question to answer. When you think about the maybe one or two biggest developments that, if they took place, would really accelerate tokenization, what would those things be? Are they regulatory oriented? I think, Chief, from your point, there's like the technology's there, but it's a question of how is it implemented and who are the different folks you're talking to? Are there certain developments that you think would drastically change the trajectory of how fast tokenization happens in certain markets?
No, I actually think that we're now all about adoption. I really think, like, a lot of times people say, are you excited about all the regulatory rules? Yes, very much excited. It's actually more that the posture of the US administration and the US regulators, to me, is much more exciting, because we believe that, the way we've built Canton is you can do tokenization within the regulatory framework that exists today. You don't need new regulatory changes necessarily to really mobilize it. And if that's the case, it's actually the posture and the excitement of the administration and the regulators of using this technology that have gotten all the clients very excited about using it. Therefore, I think from our point of view, it is really now just about rolling your sleeves up and getting to work and getting it done. I don't really think that there's anything missing to do that other than adoption.
And just quickly to maybe nuance adoption even further, in your mind, is it really all about the US market, just given how large that market is, how big the, sort of influences and setting standards like globally? I think I have this debate with friends all the time around, where is the center of gravity in terms of, interest in adoption globally, whether you're breaking it down to the Asia Pacific region, Europe, US. And obviously with the change in the posture in the US government, I think it feels to me like all eyes are on the US. I'm curious if you have any further nuance on how you think about sort of the adoption component geographically and whether that plays at all in your mind and strategy.
Listen, we operate globally, but the reality is the US market is just the largest market across the board. So, as a business, you need to kind of go where the puck is. And it's where I think the biggest opportunity is. But it's not only the biggest opportunity just with respect to the fact that the US market is the largest, but it's also because, all eyes are always on the US. Like, we remember before the current administration, everybody kept on saying the US is behind, the US is behind, the US is behind. And now suddenly everybody's trying to catch up with the US. So I think that the point that to me is much more important is if you go abroad and you're like, we did this with the DTCC, people go like, okay, that's good enough, So it's like there's multiple elements why investing in the US is so important beyond just the fact that it's the largest market.
I was just at Money 2020, and I would say the most pervasive things that were spoken about at Money 2020 were stable coins and then artificial intelligence. I'm curious whether you have any sort of view or take on where blockchain infrastructure intersects with AI-driven financial systems at all. And if you do, how you think about that relative to Canton and its value that it creates for institutions. Because I would think that if anything, in an AI-based financial system type world, maybe dystopian as that might sound, Canton would have a lot of value just given what it does as it relates to privacy, as it relates to the other components you talked about.
Yeah, the way I think about it is the following. First of all, I'm not a negative on hype. I'm a negative on hype that gets left hanging for too long without something catches up, right? Like, you must have hype. Our attention span these days is so short that you need something in order to catch people's attention and get them focused on what you're trying to do. So hype is a good thing as long as it's followed by substance. With respect to AI, one thing that I try to tell people is one of the bad things about reconciliation, which is what we're saying we're going to get rid of, is that when you have 8 people doing the same transaction and they need to reconcile with one another, if one of them makes a mistake, the probability that all 8 made the same mistake is very low. And as a result of that, reconciliation is not just friction. It's also like, you can think about it like a strainer. It's a strainer for mistakes that then get caught and people fix them, which is a good thing, right? So a lot of times people will talk about one source of truth. Well, maybe you want to make sure that your one source of truth is actually the truth and nobody injected like bad stuff into your source of truth. And the reason I say that is in a lot of the projects that we work on, AI gets used almost like a safety mechanism before you inject things into a blockchain to verify the quality of the data and its authenticity and accuracy. That's one element. The other element that, I'm sure we're going to see, but I don't think it's unique to blockchain, is you have very structured data with very deterministic kind of like state transitions. And I can see already a future where agents will kind of like start automating state transitions on a blockchain. And the whole notion of using blockchain to prove that AI models are good ones or not, haven't put much thought to it. I think it's interesting. Again, I think that when people say things are immutable, we should be accurate with those statements because it's already been proven that blockchains are not necessarily immutable.
So we're really curious, if we look out, let's call it 2 to 5 years, and digital assets been wildly successful. What does that world look like in your view in terms of, are there, we have X amount of like global value or dollar value that's, being impacted? Are there certain products that you think that don't really exist today that are now commonplace? I'm just curious, like in that future state, what are you most excited about? Again, assuming that digital asset is like wildly successful beyond like your lofty, right, and big goals.
Sure. I'll give the following example, and I've been using it a lot. As a former trader, when you think about putting a trade, you have your alpha, which is what you think your edge is, and then you have your transaction cost. And transaction cost comes from multiple sources. The cost of your people, maybe, cost of your back office, regulatory fees, securities lending, all kinds of things. There's a whole list of what are your costs. And really, the edge that you have is your alpha minus your costs. And you kind of like think about like, well, what is my margin of my edge? And if it's not high enough, you kind of don't do the trade, right? Because the alpha is statistically what you expect to get. So you want to have a good buffer in there to make sure that you capture enough return. Like there's a lot of ideas that I think people would love to do, but the cost of putting that product is so high that before you even think of like pricing it, it's like nobody will buy this product. It will be so expensive that it's just not worth it. And so to me, what's exciting is that as we are reducing kind of like the cost of managing and settling assets all the way from equities to private assets, it's the opportunity of products that today are just not feasible. So one easy example is everybody's super excited about private credit. Private credit is growing dramatically. But let's say, Alex, you own $1 million of a private credit fund and it pays you like, I don't know, like, $80,000 a year, $90,000 a year. People can look at your issuer of the private credit and your cash streams. But today, to what I call perfect the security, put a perfect lien on the private credit, know that they are going to be the first to get paid until the loan is paid. Like when you start thinking about the back office, the middle office, the legal, all of that stuff, that's your cost. So now you have a loan that you expect to get some kind of a return, but you have this massive cost and you're like, well, if I'm going to put this loan, I need to have X amount of margin, which will make the loan so expensive that nobody would ever take that loan. If I actually say I can actually pledge my private credit asset to you, like I said, like that Aave example, for less than $1 in real time, suddenly I can write really interesting loans on something like that, right? So to me, the real excitement for 5 to 10 years is I think that we are really in the first inning of seeing financial products that today would just not even be imaginable due to the friction that exists in the system are going to become available in the future. We're seeing already today, you talked about stable coins and things like that. Just imagine how treasury management gets changed, where you could actually have agents. Anytime you have idle cash, will convert it into US treasuries or money market funds. You don't need to have wild imagination to see that already happening. And just that already at the click of a button will have better yields for any owners of assets, whether they are institutional or retail. That will have a dramatic positive effect on people's returns. The reason why that is possible is because now moving money all over the world 24/7 is possible, it's cheap, and also converting money into yield-bearing assets is also cheap, quick, 24/7. So those are things that you can start doing today already.
And, maybe one question that relates to, sort of longevity of thinking and really working through long product and adoption cycles. Is there one particular principle or approach that you've really benefited from in terms of maintaining conviction through a long product cycle or a long set of adoption cycles? I'm just curious. I think that there's some element of this that, you all have built to be at the right place at the right time and also, have done that through a first principles mentality. But I'm curious, is there sort of an overriding approach for you that helps you, sort of maintain that excellence on that regard specifically?
If I'm very honest, it's been very hard to stay true to our mission for so long. It's really only in the last 2 years that suddenly you're seeing I don't know if I have a good answer to have for almost 8 to 9 years. I stayed with all of that conviction, but I don't know. I think that the people around and some of our partners, it's been extremely humbling to work with people that share an ethos of really trying to do things the right way, not for a quick, money making. I'm pretty sure that if we want to do an ICO or a pre-mine, we could have done that. I think that the people that we're doing this with want to see that in 50 years, financial transactions are still happening on the Canton. That's their motivation. And when that is your motivation, it's slightly easier to ignore the noise in the short term.
No, absolutely. Our last question to all of our guests is their high stakes hot take, which is their boldest prediction for the market or their space over the next 12 months. What would be your bold prediction for the next 12 months that maybe no one else would think of?
I actually think that we do have a real chance of having significant institutional volume on both treasuries, equities, and other asset classes already in 2026. Not just retail tokenized products, but actual real institutions doing significant amount of volume in 2026. I don't think that there's a real chance. I think it will happen.
Excellent. From your lips to God's ears, as they would say. Yuval Rooz, we'll park it there. Really appreciate you coming on High Stakes and looking forward to having you on again soon.
Thank you for having me.
That's a wrap on High Stakes, the podcast where Web3 meets the real world. For more insight into how blockchain